So we chose to do our project on collateralized debt obligations. Collateralized debt obligations are a type of security derived from other securities and regulated by the SEC. CDOs can be made up of mortgages, credit card debts, any type of loan, and the way that they work is that banks make these loans and then they repackage them. They almost bundle them like a bundle deal with other different types of loans and debt obligations, which are then sold as a package to, it could be investment banks, commercial banks, hedge funds, pension funds, insurance companies, and other major investors. So the way that that works is they purchase the CDOs, and then the reason why they're attractive to investors is because they're backed by collateral. So that consists of both debt payments and also the underlying assets from the loans that the CDO is made up of. And so the assets are sold off and then the initial loan is paid off. Thus, the CDO produces cash flows, which the manager of the CDO uses to make new loans and bundle new CDOs.
First, I want to talk about how CDOs work. There are principal and interest payments, and from these debts create a revenue stream that is used to pay investors. By slicing up the underlying obligations into different risk levels or tranches, the CDO offers a range of financial products providing different risk and return options for different investors, depending on how much risk they're willing to take on. So then I want to get into the history of CDOs and how it affected the financial crisis. Collateralized debt obligations exploded in popularity, with CDO sales rising from $30 billion in 2003 to $225 billion in 2006. But their subsequent implosion, triggered by the U.S. housing correction, saw CDOs become one of the worst performing instruments in the subprime meltdown. The bursting of the CDO bubble inflicted losses running into hundreds of billions of dollars for some of the largest financial services institutions. These losses resulted in the investment banks either going bankrupt or being bailed out via the government intervention, and helped to escalate the global financial crisis during this period. Despite their role in the financial crisis, collateralized debt obligations are still an active area of structured finance investing. CDOs and the even more infamous synthetic CDOs are still in use, as ultimately they are a tool for shifting risk and freeing up capital. The Dodd-Frank Wall Street Reform Act of 2010 was adopted with the intention of preventing the same sort of exposure that led to the bank collapse during the financial crisis. It wasn't until the Federal Reserve Bank and the Treasury started buying back these CDOs that a resemblance of functioning returned to the financial markets.